Hello, I'm Greg Bonnell, and welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights to help boost your trading potential. Coming up, big tech earnings in focus. Meta, Microsoft reporting on Wednesday, followed by Apple and Amazon on Thursday. Now, these are results that could set the tone for the markets and reveal trends in AI, cloud, and consumer demand. Plus, the VIX, Wall Street's fear gauge, has dropped to its lowest level in 3 weeks. We're going to take a closer look in today's technical take. And Caterpillar shares are down about 15% year to date ahead of earnings and a CEO transition this week. That raises questions, of course, about its long-term strength versus recent sales weakness. Our trading debaters standing by with the bull and bear cases of one of America's industrial icons. That's all ahead. You're watching TD Active Trader Live. Get you updated on the markets. We'll start with the S&P 500. About 30 minutes for trading under our belt. Not too much movement. Is it just me, or has it felt a little calmer lately? I can take the little bit calmer. We've had some ups, we've had some downs, but the volatility is settling down a bit. Probably why Hiran wants to talk about the VIX in a couple of minutes' time. Let's switch to the heat map. I want to see what is actually moving out there right now and where the push and pull is ahead of some of the big tech earnings. You have few names moving in different directions. You got Google down a little more than 1%, but Apple and Microsoft up modestly. Amazon down 1.5% at this hour as well. So you can see some of the behemoths there, some of those heavyweights on the top line number, just pushing and pulling on either side of that line. General Motors, want to talk about them. Some weakness out of the gate today. They reported better than expected profit, but they said they're reassessing their future guidance and suspending any more share buybacks. They're trying to get some clarity about the impact of tariffs in their situation. This is a name, along with some other automakers, that actually saw a bit of a boost earlier on reports that the White House was willing to make some concessions on foreign-made parts. Of course, reports, we'll see what actually comes of all that. Nothing but uncertainty when it comes to the automakers. Coca-Cola, I want to check on them as well. The stock is just sort of sitting at the break-even line. It reported first quarter earnings and revenue that actually topped Wall Street estimates. Beverage giant also reiterated its full-year forecast despite all of these trade conflicts. And of course, when we see tariffs, you think about some of their costs, like aluminum. You know, the can is made out of that. When you're drinking a Coke, they actually grew their unit volume by 2% in the quarter. They saw growth in India, China, and Brazil, so it's just not a North American story for them. And they think the tariffs are manageable. That's after one of their big rivals, Pepsi, actually cut their outlook. Interesting stuff. And that's your market update. All right, joining us now for a more technical take on what is happening out there, here in Amin, Jason Natick, our direct investing trader debaters. Guys, another show. We're just getting started.
Yeah.
Where do you want to start?
We're going to start with the SPOOS, SPX. Yeah. So we'll go with that, see how that's shaken out. I've got the chart pulled up, but this is a critical week, Greg, right? So this is one of the bulk of all the earnings that are coming out this week. So that is going to start adding a bit of more volatility. I just want to do a recap on the Q1 earnings. You know, their expectation is now come down to 6.9% growth, down from 11%. And that could... And I think everyone's looking forward. Like, what does Q2 look like for all of these companies that are going to report coming out of Q1 due to the tariff uncertainty? And so that will really shape what 2025's outlook is going to be. But coming to the charts, let's go ahead and see what's going on under the SPX here right now. So you can see that I've kind of mapped up. We've got the daily chart drawn up over here.
Oh, all kinds of great things on that chart. Yeah. I'm seeing death cross. I'm seeing gap down fill. This is going to be a good one.
Yeah, we're going to break it down, right?
This is dramatic.
There's drama in there, yeah. So this is the big longer-term trend that it's kind of bucked over the, since March with all the tariff news. So we're definitely in this intermediate downtrend right now. This intermediate downtrend was acting as that dynamic resistance all the way just until this week, where we just had a break here now. A couple of key levels that I'm going to just point out here. First is the support sitting at that 5,500. This is kind of where we're sitting. This could act as resistance coming out of this week. We'll see there's a lot of earnings, but there's also a lot of macro data that's also going to play out here. And it is just on striking distance of the 50-day moving EMA, which is sitting at about 55, let's just call it 55.70 there. So if we see the break there, we could see some upward momentum pushing through. But I'm mindful of that gap downfill there, right? Sitting there at that 5,300 zone. So if we do have negative prints coming through some of the macro data, PCE, GDP numbers are coming in worse than that, we could see a break below this downtrend and maybe fill that gap up that we're looking to do there. So that's one to keep an eye on, these key levels. I've still plotted out the worst case scenario down here at the 5,000 level. That's going to be the key level for SPX throughout this year. It breaks through that. It's and this is mapped out on the August lows from last year as well. So this is the one we're going to keep a close eye on there on the SPX and see what we get there. So 5670 and 5,500 there are the ones to keep an eye out for on the upside. All right. And then, of course, we talked about the VIX. Yes.
So it's just not me then, right? Things have been a little less volatile in recent days.
Yeah, I've heard a few rumblings. Maybe
I'm sleeping a bit better.
Yeah, exactly. You get some peaceful sleep now. So we've seen a meaningful, obviously, decline. We saw this, anytime you see on the charts, you see the VIX, any sharp sort of moves up, it's usually preceded with a sharp drawdown as well. And that's no difference with the VIX. It's actually kind of part and parcel of its personality when it comes to how it moves. So we saw the highs hitting the 60. We saw it taper down, of course. We saw large wicking candles, really big ranges coming through that. But that's almost like the calm is there now. The candles are not as wide as well. And we're teetering on this like sort of support or resistance what has been in place for the last like year and a half, which is at that 23-24 zone. So it's going to sit right over here. The big thing with the VIX, as you mentioned, we saw it down 15%, sitting at the 25 level at the moment. But the one level to look at is the gap fill on the top side. It hasn't closed that out yet, and that's sitting 38. So that's a little bit of volatility we could head into. And what's going to maybe prop that up is going to be the macro data again. The GDP numbers and PCE are going to hold key, and the jobs numbers at the end of the week. So if we see those disappoint, we could see a little bit of a spike coming into that. And the one last thing I'll also mention is the futures on the VIX as well. We know about contango, which is like the normal sense that you have usually volatility in the near term that's less than the further term, far term. So as long as contango is normal and there's no backwardation, we should have a little relative calm and continue on with the way that things are going. All right, and that brings me the semis. Yes. So let's talk about the news, what's happening on semis. So the one I've got drawn up here, it's index SOX. It's the Philadelphia Semiconductor Index. So this index essentially tracks. It's a market capitalization index comprising of the 30 largest U.S. listed semiconductor companies. One thing you can see, we're in a downtrend, of course. Ever since like those February highs, we've hit this downtrend. Now it's the breakthrough that's happened. We've seen a breakthrough happen. Now what it's also formed is this crude W pattern, and like we like to say, these are like kind of wins. If it does break through this sort of line up above here, that could push for a further move going back towards the 150-day moving average is what I have at the 4,700 level. But 4,400 is the near-term resistance. Big news coming out of the semiconductors, which this week happened, was NVIDIA took a little bit of a hit for its eroding margin. They reported last week those export controls that are coming in place. But coming out of China, Huawei is going to be rolling out its AI chip processor in its test phase with Chinese companies. It's called Ascend 910D, and initial reports suggest that it's really, in performance-wise, it's on par with NVIDIA's products there. So that could shake up a significant market for a lot of these semiconductors out on the China base, but tariffs are still front and center for all of this there. So we'll see how that shakes out.
A lot of shakeups for the semi space out of China this year. What are you keeping your eye on, Jason?
Well, this is a little company you may have heard of. We're going to look at Amazon here. There's so much going on, Mag 7 related, tech related this week that we wanted to make sure we had a chance to kind of speak to a lot of it. So they've got earnings coming up. We're talking after the bell this Thursday. Lots of news just recently. I'll keep it brief here. They had a price target cut by Oppenheimer this week from 260 down to 220, highlighting some of the concerns around tariffs heading into Q1. The news that kind of caught my eye is one around Prime Day. That's a big shopping event that comes up in the middle of the summer. Well, there's some big news around some of the big partner from the Amazon's world, and that's their partners in the third party sellers. As much as 70% of the total sales on Amazon come from third party sellers, and 70% of that merchandise is actually coming from China. So some of those resellers are actually going to be taking a pause, and they've come out and said this. So this is kind of breaking news over the last couple of days that they won't be participating because they want to protect their margins on the goods that they're selling. Let's jump into the chart. We can see that we've got over the last number of we're talking about a little over 2 years here. Been on a pretty steady upward range. But now, if we zoom into kind of near-term trading, Amazon's trading towards the bottom end of that range. Obviously, waiting on the big news ahead of earnings. But there's been some relatively positive signs in the charts. Let me bring up my drawings here, and if we can go see here, as we approach the bottom end of the range, we've broken out of the triangle. But there's also, Hiran mentioned looking for W's in the chart with his analysis. We can see there's a double bottom that formed on Amazon that pushed it above the bottom end of the range. So interesting to see if we can see that'll continue. We did see the price cross a shorter moving average, so another bullish sign. But still, the market is going to be waiting. And actually, I'd be remiss to say there's one kind of news that we were chatting about before we went on air around Amazon, going public with around the pricing effects, the tariffs of.
The White House is not pleased.
The White House is not
pleased with that.
Exactly. So we'll see how the market reacts to that displeasure as well.
Interesting stuff, guys. Thanks for that. If you at home have a question for our team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website. You can find more information about all of our trading platforms under that Get Started tab, so you can find the one that is best suited for you. And if you're interested in trying out the TD Active Trader platform risk-free, you can open a practice account by clicking here on the Try TD Active Trader button. Whether you're a new or seasoned investor, TD Direct Investing has you covered, and has once again for the third year in a row been ranked as the #1 online brokerage in Canada by the Globe and Mail. It is time now for Trading Debating, the centerpiece of the show. This week, the stock on the spotlight is Caterpillar. Before we get going with that debate, just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Options trading carries high risk, may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Now let's get back to the stock of the hour. Caterpillar, what made you guys pick this one to debate? Here.
It's an industrial bellwether, Greg, right? I know it forms the bedrock of like the Dow in the American industry. It's one of the largest or leading providers of heavy equipment machinery. And how can you not miss those iconic like mustard yellow branding on there? So we figured it's a timely for this time of the year that what they're going to inform will inform kind of the wider industry of construction, machinery, industrials, how they're shaping up.
I always looked at the mighty machines, Jason, trying to figure out how the global economy is going.
You got watch when they start to do their digging, whether or not you're a kid at heart, or maybe you're a kid even having the Tonka trucks of the Caterpillar toys is always a staple of your childhood. But lots to dig into. So looking forward to having the chat.
Right, that was a nice part. Now we get professionally mean. We're going to have some time on the clock. Each have 2.5 minutes to make your case. We give you some time to counter, as always drawing from a hat. And so what do we get this week? I don't even know. This is like a surprise for me. Hiran, you got the bear case. So why don't you kick things off?
All right. So I'm going to go with this one. Okay, let's talk about it. So I just wanted to mention that with Caterpillar, of course, it's across different segments when it's revenue makeup. If you look at construction industries, resource industries, and energy and transportation, but it is a business that is cyclical to the business cycles and to the economy as a whole there. Especially it's prone to construction downturns and also with resources as well. And that's what I'm going to start with. Talk about the macro headwinds here. You've got cyclicality with economic slowdowns. There's some data that's already informing us about that. I'm going to take a top-down view here first. When you look at the ISM numbers coming in, manufacturing numbers have slipped already for March. There's a contraction. New order indexes have also slowed, below 55 to a reading of about 45. So anything below a 50 on these measures is a contraction in the sort of overall economy there. Also added to this, you have high interest costs. These don't come cheap, these products. The Tonka toys might, but they don't dig a lot.
Even they're not cheap anymore.
Not anymore, right? Yeah. So it's affecting everyone, of course. And so high interest rate also just means that dealers are going to pass on these costs to customers. Customers have to fork it out, and maybe they're not going to have those volume of orders. Which also brings me to the second point, talking about volume as well. They did see a decline in the volume. In fact, management got in front of it and said, we're going to come to a decline in volume there. I'm a little bit lost for this. Okay, yeah. 11% drop in volume, 5.3% drop in pricing as well. They're also coming with operating profit coming into this quarter with a year-over-year decline of 21% there. I'm just internally my clock is going on, so I just want to pull up the charts and we'll go grab it. We'll reserve the other points for later. So what's happening on the chart? Got the weekly one pulled up here for us. Key things to note is we've got this sort of rising wedge, which is this, in fact, a bearish reversal sign over here. It just teetered on this lower bound here. Weekly resistance is sitting up over here. I'm going to just draw into the. We'll go into the daily one just for a second here, and I just want to show the patterns that are following through over here. So in the daily, of course, very different story. Completely on a downtrend over here. We saw it broke below this when the tariff news had hit there. It is finding support at that 300, but this is the level that it's going to fail to break at, and if it doesn't hold at that level, it's still bearish on the signal. The other thing that I'm also confirming is there's no volume on these prices. You've got very small candles, which indecision. These are like doji candles. They're not really deciding one way or another to take the price, but the volume is not there, even if the direction is there, and that's what makes me think that these levels are not going to sustain. We should see it trickle back below this support below 300 and fill the gap. There's a gap down fill at 290, so that's another place that we could see the price falling down coming into this earnings.
Look at that, didn't even have the benefit of a clock. A very efficient argument there.
Well timed. You played that.
Thank you.
Nicely,
Yeah.
All right, Jason, what do you got for us?
All right, so this is the cyclicality, I think, kind of plays into the strength. This isn't like a flash in the pan company, as we mentioned off the top. This is a company that's been a bellwether for over 100 years. One of the things I wanted to point in, there's, I don't know if you want to call it a niche group, but there's something called a dividend aristocrats, right? These are companies that have increased their dividends over the course of a minimum of 25 years. There's only 69 out of 500 companies on the S&P 500 are in this select list, and Caterpillar is amongst them, joining them in 2019. And it's that cyclicality of their business that really really shows to how well this company is run and to the strength and management that they've got going on here. And another factor that kind of jumps into to show that this is something that we think can play out for a longer period of time is that their payout ratio is under 25%. That's a full 5 points lower than anybody else in their sector. So they're well positioned in terms of the cash that they're sitting with. All right, then we think about there's all sorts of grumblings going on. We can't avoid it globally here, but Caterpillar is a global superpower, right? There's significant revenues coming from all over the globe. North America is the driver, making up 53% of the revenues, but Europe, Middle East, and Africa, they're just under 20%. Asia Pacific is 17.5%. Latin America is around 10% of the revenues that come in, and the company is actually well positioned because they have a manufacturing footprint globally as well. We're talking U.S., China, Brazil, Thailand, Germany, and UK is producing products, guarding them from isolationism and protectionism. And former CEO, I don't know if he's former, what is it, tomorrow? His CEO, Jim Umpleby, is saying that they're actually well positioned from the tariff perspective because they are a net exporter of products. All right, so let's jump into the charts. What I want to highlight for everybody here is over the last little while, we can see that I'm always looking for just kind of interesting things, unique things that are happening on the chart. There is a big zone that I've seen develop on the chart where the price has very rarely been over the last 2 years. We saw it trade up quite quickly at the start of last year and then gap down towards beginning of April. But what's really interesting to see is we've seen that company or the stock prices then begin to bounce back up. That gap down that happened in April has been filled in. So we're seeing some positive price action there. But if we even want to go into shorter term turnarounds, yes, we've been pulling back. I want to highlight one of Hiren's favorite patterns. We've got a cup and handle pattern that's on display for everybody to see. Really near term, we've seen the company begin to pull back. Or begin to show an upward trend, and we've now seen that with the cup and handle have been able to kind of succinctly present itself. We've got an upside move of almost 7.5% potential.
All right, there's the debate. Now is the time to counter. What do you got for us?
All right, I'm gonna take a stab right at Jay first of all. I know you presented
personal now.
I know you presented it's geographically diverse, but you have to remember that they are if they are manufacturing these parts all over the world, there's still tariffs that are impacting the cost of this, and that's already shown on. Management has already said that we're going to have higher costs coming into this. The other thing that I wanted to talk about was the revenue makeup, and you look at the specific industries they're exposed to, which is construction and going back to resources. That makes up 60% of their revenue, and they've already come out and said, like, this is going to hurt our bottom line. In fact, they've dropped on the resources 6 quarters in a row. They've had declining revenues there, and the construction industry has been 5 consecutive declines. This is 60% again of their revenue that they're guiding on, and management has come out with guidance saying, look, we're coming into Q1 with a weaker guidance. What's going to make me think is, what does Q2 hold as well? Like, they're not just coming out of this. This is probably the start of a drawdown that's going to come out on that.
So sales they've been admittedly lower, but the margins the companies are operating has actually been moving in their favor. So they're being efficient with their capital. One thing I didn't get a chance to in the short time I had earlier was to talk about 2 really interesting ways that the company is making money outside of just selling their hardware. And that's, one is going to be these kind of ongoing, they call them customer value agreements, where they're signing up customers for kind of service contracts. So it's a repeatable source of income, and which is generating that predictable income as well as brand loyalty and kind of diversifying revenue. And then the second thing that's really interesting off that is around the CAT Financial. So this is where they're actually lending out to their purchasers. So they're making, it brought in roughly $3.5 billion of revenue, which is 600 more than it was the previous time. So it's a 6% year-over-year increase in profit coming from those lending exercises. So that's certainly.
Yeah, but the makeup is so small though. That's not going to make up for their top line revenue numbers. So what are you going to do about that? Look at EPS. At the end of the day, it matters. What are they able to keep their profit margins? EPS has been sliding. 4 quarters of 2024, they were averaging, I'm just going to call it 550 EPS. They're coming in 430 on this time. 23% decline. Quarter over quarter is what they're going to have. The other thing I have is the problem with the valuation. It's a value trap. They're valued right now on free cash flow. Guidance from management said between 5 to 10 billion. Put the midpoint at 7.5. They're sitting at about 135 billion market cap. But if to be more in line with where they're generating the free cash flow, you put 15x multiple. That brings the share price down to about 235 there, and that's being aggressive there. Of course, right now they're sitting at 300. So even from a valuation basis, and even from a competitive lens, Komatsu, which is another big player out in the Asian space, Japanese manufacturer of heavy machinery. We know John Deere, in fact, I didn't realize they'd get into heavy machinery as well for construction. But these are valuation standpoints. Caterpillar is significantly
whether or not we're talking about this price or we were earlier prices from this time last year, Caterpillar continues to see value in itself and continues to buy back shares. There's been a $20 billion authorization of buybacks. They're on average $2.4 billion per quarter is what they're buying back and returning value back to the shareholders.
Can we strike that last part out? It was overtime.
Your Honor, where's the judge? We should put a judge over in that chair over there.
Yeah.
The gavel, the whole deal. All right, nicely done, gentlemen. Now we're going to dive into the TD Active Trader platform and talk about possible ways to play this based on a bear or bull position through options. Let's start with the bear.
Yeah, so I'm going to bring up my charts here. I just wanted to map out some of the levels here. So I've got the Fibonacci retracement over here. So what this pattern really tells us is about levels and when we see the prices coming down, where the retracement levels that we're seeing over here. Now you can see from the top to the bottom where we saw from starting of the year to hit the bottom right here at 267. We see this is kind of this 23 areas, kind of that what is acting as support, but what could be resistance if it falls down. So probably the price drop right now sitting at that 267 at the best. When I did do my levels though on the daily, we're looking at about a 240, 250 price target here. So one of the things that I'm going to be cautious about going to this trade, I think there is going to be an outsized move, and we looked at the options chain here. They're expecting a pretty significant move. Now coming into the June cycle, just for them to kind of weather through this, what we're going to be looking at, probably helpful to have the right symbol in there to start with. There we go. Knew something was odd with the price. All right, so there we go. So the trade that I was considering on this one is playing to the downside. Again, because it's volatile and the premiums are quite expensive, the trade I'm going to be looking at is doing a bear put spread, essentially. So we're going to be doing kind of at the money. So we've got the $300 strike is what we're targeting. We're going to go down to that 280 level, which is going to put us just slightly above where where the retracement is at the very bottom. If it doesn't hold that key support at the 23.8. Right now, it's a net credit of about $6 is what we're looking for on this trade. It's a 20-point spread. So if the worst case scenario, I know you like asking that, Greg, what if the trade doesn't work out the way it does and actually goes up? So that's where we lose out. So if the stock holds above the 300 level coming out of this earnings, we're going to lose on this trade, but we do have time on our side. But the best case scenario, of course, if it does fall and we want it to fall below 280, we're going to capture the value of the spread, which is $20. We paid $6 for it. The difference is going to be what we're going to be bagging as a profit, $14 there, or $1,400 on a single contract there. So a couple of things to be mindful of is the volatility in there, capping my risk, of course, to the downside, and it gives me a good risk to reward ratio, about 1 to 2 on this trade if it works out.
Interesting possible way to play it. How would you perhaps play this?
Perhaps. Let's walk through some different choices. Now, I always want to just very much like hearing, I want to understand kind of where the stock is potentially going to go. So where do we think the stock is going to go, and when do we think it's going to get there? And one of the ways we can do that, we've talked about it in the program in the past, but let's jump back into the option chain to see, is to kind of price in kind of the move that the market has. We do that by pricing in the at the money straddle. So if I look at if I'm buying the 305 straddle, that's pricing in, call it $12.30. That's telling me what the market's expected to move up till that expiration date. So one way we can play this, and sometimes if we choose to play with a credit on an option trade, that gives me a little of additional flexibility in terms of the trade that I can make, because I can make money if the stock goes if it goes up. I can make money if it stays above the strike price that I'm selling. If I'm thinking about puts, I can make money if the market consolidates and goes sideways. I can even make money if the stock goes down, just not down by too much. So here's an opportunity for me to bring in some trades, give me a little flexibility, but take in some credit up front. Pricing in that move of the $24. If we're thinking about selling, we want to sell with something. The goal for this is to have it expire worthless, it's out of the money. So if I've identified strike prices here, if I can sell a 285 put and then buy something a little bit further out of the money. Right now, if I'm buying that, it's 470, or selling the 285, that's 470, and then going out the door would be 340. So there's not a lot of premium on that particular trade. So what I thought we could do was also, we're going to take a more of a range-bound trade opportunity to take credit on both sides. If we sell a spread on the put side, as we've done, but also take the opportunity to sell a spread on the call side, both times looking at probabilities, we want to keep them low because our goal is to have this expire worthless. If we think about deltas, 20 or below, that could be a really chance that the math is on our side. But I want to take us into the chart, to very much like hearing this, so I can, one of the strategies I like to do, if I jump into the chart quickly, I've taken the chance to put the strike prices, the short strike prices, on as a visual. So one of the tactics I like to do is to put these here so I can really get a sense of what don't I want the company to do, and by putting those lines, it really allows me to visualize how realistic, how likely it is if the company moves against me that I'll be in a lost position. So the trade I'm talking about here is I've got it on the screen. We've got two $10 wide spreads, 285 on the put side, and the short 275 long, and on the flip side 335, 345 on the call spread. So two $10 wide spreads, bringing in a credit of around $3 for me there.
If it goes against you.
That goes against me. Let's jump back quickly into the platform that I've got I've drawn up the trade on the Analyze tab. So this is a really nice way to risk it. Wherever I put my mouse, it's going to tell me at that price level that's running on the bottom of the screen what that is going to be from a profit and loss perspective. When we're thinking about iron condors, we lose if we get outside of our short zone and gets past our long strikes. That would mean we would be taking on max loss. So outside of 275 and outside of 335, what's happening there is we're taking in $3 credit. These are $10 wide spreads, so the max loss would be $7 or $700 per contract.
Right. Fascinating stuff. Thanks for laying out the bull and the bear cases for Caterpillar. A reminder to our viewers that this debate was for educational purposes and does not reflect our personal opinions about the stock, beyond the little toys that Jason liked when he was growing up, right? Before we move on, Jason, you're going to elaborate on the tool on the platform called the Trader Ladder.
Absolutely. So this is a really interesting tool that it really helps to bring together and visualize multiple aspects in the market. So we get to see kind of where trades are happening, we get to see volume, we get to see where bids and asks are. So we're bringing in that depth of the market into one consolidated view, and we can actually place trades in this as well. So it's a really nice way for us to quickly take action in the market. So let's pop in and I'll show you exactly where we can find that. In the default settings on the platform, we happen to be on the trading tab. Under the sub tabs there's something called Trade Ladder. Now, if you're looking to kind of add this to your own workspace, if we're in the widgets section under the trading, you can see that the Trade Ladder is there for you. You can customize your own experiences like we get into in some of the master classes that we teach every Wednesday. Feel free to join us for those sessions if and when you've got some time. All right, so looking at the Trade Ladder, what you'll notice here is called a ladder because everything's stacked, all the prices are stacked vertically on each other. So to orientate everybody here, I happen to have Apple up on the screen for us. And I actually have a position in my demo account in Apple. What's really cool about this, I get a visualization on the left-hand side of what my individual P&L is on those positions. So my demo position isn't really working out for me so well. It's so hot right now. But to talk everybody through what we're seeing, you're noticing the bids on the left and the ask prices on the right. So we're seeing the size. So this is a depth indicator of what we're seeing of all of the trades at the individual price points. And further to the left on the screen, we can see the volume. So we can see kind of those points of control as they happen. We're able to notify where other people are trading. So we're in one screen, getting a really nice picture to tell. All right, and then lastly, if we want to trade on this particular screen, it's just as easy as pointing and clicking. All we really need to do is if you hover over the price at which you'd like to purchase it at, in line with the bid or in line with the ask, that's going to instantly in one click generate an order. And one other really quick feature I want to show to everybody, if you take a look towards the top of the screen, if you've got a trading plan with profit and loss targets you set for yourself, if you're in one click of a mouse, if we change this order template from single down to, let's just choose first triggers OCO, if I go ahead and select that, if I go ahead and I can adjust the width of this spread here, at one click, if I click a buy order at a particular price, it's automatically setting that, and I can visually see it, so it can line it up with how the market's been reacting and where the pricing support levels are. So it's a pretty interesting tool that I can quickly interact and get a lot of visual cues to help me with my trading.
When those three popped up, I actually thought, very cool.
Yes.
Very cool.
Pretty cool,
Powerful tool. All right, thanks for walking us through that. If there's a stock that you at home want to see our debaters go head-to-head on, send your suggestion to td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website. If you scroll down, you're going to find a tab that says Join a Live Masterclass. This Wednesday, 2 p.m., the team is hosting an interactive session about TD Active Trader, which will explore all of the different options you got there. So registration is required, and it's open now. Another great show, sadly coming to an end, but of course, plenty more to come this week. What are you guys focusing on here?
Yeah, so I kind of alluded already to it earlier, Greg. We got some macro data that's going to be key for this week. GDP, PC, and non-farm payrolls are the close ones I'm going to keep an eye on. GDP is going to be interesting because the forecast analyzed growth is at down 0.4% from the 2.4 in the prior quarter. Now, if we do have that contraction of that 2.2%, and it comes negative, that print comes much more negative, then we're going to see that's going to obviously stoke fears of recessions again, and we could see a major sell-off in equities. Then with PCE, that was expected at 2.2%, down from 2.5 the previous, and again, we know this is the Fed's preferred inflation gauge, of course. Lowered reading might boost optimism and chances for those cuts, but if it persists, then of course they're going to maybe stay the course. And then finally, non-farm payrolls consensus is going to come at that 170,000, but if it comes much lower, then of course that's going to bolster it there. So we're just going to keep an eye on those three things for this week. That's going to sort of maybe disrupt the market. But other than that, we've got some big tech names coming in. Apple forms one of those, and that's the one I'm looking at. I've got the chart pulled up on Apple. A lot of interesting news coming from Apple. Of course, the biggest exposure is to the whole tariff in China as well, and that we're going to get some news now how that's actually weighed onto their last quarter. They've been grappling with weakening iPhone sales. Now remember, iPhone comprises of 55% of Apple's total revenue. That's your
product, right?
Yeah, so they need to protect it, and they did, because we saw when the tariffs enacted, they flew like cargo planes. It's no more ships. Yeah, this is the expedited shipping is now chartering flights and bring them. Yeah, bring it over here. So expectation is good on that front. So we should see if there's any costs, what that's going to be. But they're also shifting production away from China, trying to move it to India. That's the other big story coming out of it. So those are the key ones to keep an eye on. Apple's in this downtrend, though, coming out of here. They just broke through this downtrend, just like many other tech companies did after these tariffs. So the levels that they want to recapture is if we see a good sort of quarter and what they see going forward with this and how they're going to handle the costs, that's going to be a key. And also the other segment is the services revenue, which is their Apple TV Cloud, iCloud, Apple Pay, the streaming music. That's going to be key to this 220 level. If they break through that, then they could go back, resume possibly into a new short-term upper trend there. So that's the one I'm going to keep an eye on there for you.
Interesting stuff there. What are you taking a look at, Jason?
We've already uncovered my apparent love of Tonka trucks and things like that, but I'll date myself even further. I was having a conversation this weekend with my boys around the cost and how when I was in high school, I used to be able to get a Big Mac combo for $4.27 taxes. That is certainly not the case any longer.
I thought you were going to talk about kids' birthday parties in the train, the McDonald's train.
Yeah.
I may be going back to that's like that's a 70s phenomenon. You could get a little train. And
before my time, but that sounds dreamy.
That was what you got in the Happy Meal?
Happened for me once in the 70s.
Oh, wow. You're living the life. That's great. Yeah. All right. So, we're looking at McDonald's here. So this is actually a company we debated about debating on this program.
Yeah.
But we couldn't lock down the earnings date, but it looks like it's I've been able to identify it's coming up this Thursday after the bell. So what am I looking at just really quickly here? Tariffs they're not immune. They're a global producer. Now they do locally try to source a lot of their ingredients from domestic suppliers, but that's not always possible. In the U.S., their biggest market, they do produce most of it there, but a lot of their stuff is covered by the USMCA. But that's not to say that when there is not able to cover beef for their products, they are bringing that in from. It's typically Australia and New Zealand are bringing that in. So if they're subject to 25% of tariffs, then that could be a big effect on the bottom line. One of the things we'll be looking for in terms of their earnings number is those same-store sales. The same-store sales unexpectedly beat last quarter to the tune of just simply 0.4%, with a projected loss. So that wasn't enough to push the stock upwards on earnings. And one of the interesting facts that I've been able to come across here is that the loyalty program that McDonald's has actually been pushing frequent customers into their stores more than 15% of the time. So that's not nothing when we're talking about a global consumer base. But taking a look at their chart ever so quickly here, I've noticed on the chart there's a bit of an inflection point. It's kind of that support resistance zone around $300 that the McDonald's has been kind of ebbing and flowing. It's been firmly above that since the start of this year. They've actually been able to broach themselves over the $313 resistance line that's in place. So the company is looking to see how that's going to test. The price has been following the shorter-term moving average, using that as kind of like a near-term support point. So interesting to see if that continues. And lastly, the thing I'll bring up onto the chart is just into earnings. It's bounced off the upper band. It's been retreating back towards the middle band. Still firmly in bullish territory, but we've been coming back towards that 313 price level. So we'll see if that can break down, because if we do, $300 could be the next logical place that it pulls back to, being that's been a pretty consistent level for it over the last kind of year or so.
Interesting stuff. Lots to watch and lots to talk about when we join again next week. When we meet again.
We'll see you here. Yeah.
Let's put a saying. In layman's terms, we'll see you next week. Thanks, guys. That's our show for this week. As always, investors should perform their own due diligence before trading. Thanks for watching.